Hey guys and girls, it's Nathan here from B.Invested.com.au and I'm answering questions coming through from Facebook today. I've got a question here from Thomas. The question is what happens with interest rates rise with all that debt? Good question. That's why it's important to, I don't know if you're asking myself or whether you're asking in general. For myself, and this is what I look at people's property portfolios based on, is that you want to make sure that you've got good buffers around you as far as having good equity, buying properties that are below market value. You want to make sure that you've got a strong cash flow. So in the early days of my investing, my properties were worked on, neutral cash flow is what I wanted, and then over the years they become positive cash flows and rental increase. I have been through times of interest rates rising, interest rates coming down. When I was first started buying properties, interest rates were around the 8-9%. They got to there within like 2 years of me buying properties, and that's what formulated the plan of making sure that I buy properties with a strong cash flow. Very important. When I work out cash flow sheets, when clients come and buy properties through B.Invested, through property investment agents, we make sure that when we send out a rough forecast of cash flows to our clients, we always work on a higher interest rate, and currently I'm working based on the fact of a 5.5% interest rate. Personally, I think if interest rates were more than 5.5% in the current market with the prices we've got in Sydney, there would be trouble. So I don't prognosticate that interest rates will rise highly anytime soon. I don't think they will rise anytime soon, looking at the channels of where I get my data from. However, it's something you always need to be in mind, because you need a plan A, a plan B, a plan C, and a plan B for your plan A, and a plan B for your plan B, and a plan B for your plan C as well. So it's something that making sure that you've got buffers in place, making sure that you've got calculated cash flow analysts on your property portfolio, and making sure you're buying the right properties in line with your goals. So answering your question from my personal property portfolio, I'm in the tune of $500,000 a year profit from my properties after all expenses, including council rates, water rates, all that sort of stuff. And I expect to get that to $1 million anytime soon. So there'll be a lot of interest rate hikes there before I'd be seeing it as a concern, and always like to look at each of our investors' positions when they're buying properties to make sure they're not putting themselves in a position at risk where they could buy too many properties and have an interest rate hurdle come at them. So keep the questions coming. Facebook.com/beinvested.com.au. Have an awesome day.